Hello everyone and welcome to Mackenzie George & Company's presentation on financial statement analysis. In this one we're just trying to encapsulate the whole financial statement process into a simplified format for you so that you as business owners can just take the process and apply it to the businesses that you're looking at so that you can find the right business for your needs. The seminar agenda is just going to be two-part. First of all, we're going to look at the financial analysis procedure that we recommend to our clients. And the second part is just a little bit of ratio analysis to substantiate the findings that you come out with after the financial analysis procedure. When you're a business owner looking at financial statements, essentially you're asking yourself 4 questions. And depending on the answers to these questions, you'll be able to know whether or not it's a good business opportunity for you. First off, of course, will I make money? At the end of the day, when we invest in businesses, we want to make money. So the question, it's a good thing to bounce this off other people, trusted people, and ask them, what do you think of this business? Just on a common sense level, these other people might be able to tell you things that you may not have thought of. I don't know what blank means. If anything comes up in your financial statement analysis and you don't know what it means, it's always best to ask. And of course you ask your trusted friends, so would you buy this business? It's a very candid question and it causes them to really give candid answers. So financial analysis procedure, how do we pick a winning business? Well, we're going to look at 3 stages in the financial analysis procedure. We want to identify the parameters of our financial analysis. Our parameters are profitability, return on investment, and solvency. When we're looking at businesses to invest in, we want to make sure that we achieve these 3 parameters of profitability, return on investment, and solvency. We want a certain level of profitability, and we want a certain level of return on investment, and of course we also want some solvency. So those are the parameters that determine how the numbers should look before we make a positive buy decision on a business. Second of all, we're going to go down 11 from these 3 parameters and look at measurements. What do we want to see in profitability? Well, we see these 5 points. We want to certainly have gross profit. That's one of our measurements of profitability. Administrative expenses as a percent of revenue, we want to look at that. We want to make sure that these admin expenses are not too high. And growth year to year, we want to see a business that's growing year over year. Net profit after taxes, and can we recoup our investment in a certain number of years? Same, we also have measurements on return on investments and on solvency. Now this is just a YouTube shortcut of the presentation. The full presentation we present in webinar format, so we'd have to be a little short in this YouTube presentation, but this just gives you an idea of the financial analysis process. So these measurement points, they're just measurements that are under the 3 parameters. When we look at the 3 parameters, we have certain measurements that we want to do, and this is all part of our due diligence process. We're measuring the profitability, return on investment, and solvency of the business. Third off, we take action based on those measurements. For profitability, turnaround ideas is not usually a reason to buy. We really don't want to buy businesses for just a turnaround purpose. We might find businesses that are really down on their story, but it's not a good reason to buy a business just because it's down and it hasn't been making money. It requires you, the business owner, to really bring it up to the level it needs to be at. We also want a business to provide good customer service and invest to increase revenue. And we also want to make sure that we're running the operation better. This is going to lead to better profitability. And we also deal with return on investment. Will the business provide a sufficient return on investment? Is the product saleable? These are questions that need to be asked. We're not just looking at the numbers here. We also want to look at common issues that are going to determine whether or not our business is profitable in the long term. And we also have 4 points under the solvency parameter. Can we do with less? Can we do with less expenses, which will increase our solvency? Can we provide quantity discounts? And some other points that we can look at to determine whether or not the business is solvent. Financial analysis procedure, specific items that we also want to look at in addition to looking at these parameters, measurements, and actions. We want to look at to see if there's any seasonality in the business, because if there is seasonality, we want to account for that appropriately. We're going to have a slow time in the business, so we have to deal with that part of the business accordingly. Cash requirements. What is the cash going to be required in the business to run the business effectively? And do you as the business owner have access to these working capital requirements? Specific items, we want to have a good long-term strategy in place in order to facilitate the success of the business. Do you, the business owner, can you, the business owner, see the long-term strategy? And can you take a company forward for 10 years and achieve profitability? These are specific questions that the business owner needs to ask. And the answers to these questions will determine whether or not the business owner is actually a right fit for the business. We're looking at specific financial statement components in our procedure here. We want to make sure that revenues year over year, a 3 to 5 year trend, it's nice if they're increasing, and if they are decreasing, well, why are they? Decreasing revenues could mean a red flag, or it might not necessarily be a bad thing at all. It just needs new management to come in and kick the tires and really get the operation running on a proactive basis. We also want to look at variable and fixed expenses as a percent of revenues. In our other business growth model seminar, we talk about wanting to find a business that has a 20% profit margin before taxes. Well, a large way of getting that 20% level is watching your variable and fixed expenses. Total owner draws. What compensation do you need as the owner, or can the business provide? We want to make sure that the money we as business owners get out of the business is sufficient for our needs. We also want to look at any variances in expense items and be able to give a reason as to why there are these variances. And is it feasible to pay off the loan with the cash flow, the loan that we'll take to buy the business? In the business growth model seminar that we have, we're really looking for businesses that have a cash flow that can provide us with the ability to pay off the loan in a 5-year period. Specific items on the balance sheet that we want to look at. We want to compare accounts receivable, inventory, and revenues. If revenues are stagnant or falling year over year, and AR and inventory is increasing, that means not just falling profits, but we're not able to collect. And those profits that we do see, they might be inventory profits. In other words, on an accrual basis, if you have a really high inventory, that'll actually show us profit to the business, believe it or not. But if we have stagnating revenues and a high AR, we're probably going to see that there are going to be cash flow problems. Those will result in the future because we can't collect on our receivables and our sales are decreasing at the same time. We want to look at working capital ratios. Can the business survive for a certain period of time if it was to shut down? We need to make sure that the cash flows of the business are sufficient to cover assets, usually on a 2-to-1 basis. Non-business assets in the company, that's bad for tax planning, and that we go further into that on a corporate tax planning seminar. We want to have our debt ratio under control. We don't want to have a really high debt ratio, which means that we're really exposed to interest rate risk. And amounts due to shareholder. If this was the original amount invested by the previous owner, why has it not been paid back? If you see large amounts due to shareholders, why is the vendor who's selling the business not taking that money back? That could suggest that there's just not enough cash flow to pay off such a loan, which would be considered a red flag. We'll just go forward here, and some qualitative factors that we want to look at. We want to look at the market, the demographic. We want to make sure that the business that we're in is in the right market, it's in the right demographic, that we're going to have the right people around us that we can sell our products and services to. And you can look at that this slide in further more detail. It's a key component in the trust selling process. Is we really make sure that we can sell the product and service that the business is in fact selling. We have to make sure that the clientele is going to be able to come to us, and if they don't come to us right now, do we have the ability to market sufficiently enough so that the people are going to come? We need to make sure that the marketability is there for the business. Second component of the presentation is, and this complements the financial statement analysis, is ratio analysis. Analyzing the ratios of a business really substantiates the claims that you came up with during your financial rate statement analysis. And we have an acronym for ratio analysis called PALR, standing for profitability, activity, liquidity, leverage, and rate of return. And this next slide shows the types of ratios that we like to undertake for each section. And on the right hand side, we've got these standard amounts. So you'll look at for profitability, we're really looking for margin before income taxes and management salaries of 20%. That's really the key in at least our business growth model seminar that we give. In which, in similar rate of return, we're looking at 20% per year. This can really facilitate the ability to pay off a business loan in a 5-year period. So I want to thank you for joining us for this financial statement presentation, and I hope it came into good use for you. We have some other seminars in our Navigator series, in addition to the main one, which we provide the business growth model. We also have the seminar on business valuation. How do we value businesses, i.e. how do we put a value on what to pay for business or what we can sell a business for? And business audit proof also shows us how to protect the assets in our business so that we can run our business more effectively and efficiently. And corporate tax planning, when the business is making the money, how do we plan effectively so that we keep all the money that we can legitimately. Thanks again for joining us. We offer 3 main programs at Mackenzie George & Company. Our Business Navigator program, which is designed for people, for business owners to just organize their own business, their family and estate affairs. And we also have the Business Optimizer program, which takes into consideration the optimal way to run your business. We're also the Business Maintenance program, which is our program for small to medium-sized business owners for bookkeeping and financial statement preparation and tax returns. So thanks very much for joining us, and I hope this information came in handy. We'll see you again.